Yes, well and good. Thanks for coming, Mike. Thanks for coming, iPhone. That's the name I'm saying. Thanks for coming,
Come,
Richard. Thanks for coming, Sarah. Thanks for coming, Blessed. Thanks for coming, Scott. All right. So without wasting time, let me share my screen. So today what you're going to learn uh, is something that is going to be tricky for majority of you. We are going to go deep down what we call the liquidity concepts altogether. So if I begin by asking to you, what is liquidity? If I ask one of you, what is liquidity?
it's money.
It is money. Okay. Blessed, what do you think? What is liquidity? Anyone to contribute? What is liquidity?
Personally, what I know about liquidity is the value of an item in monetary terms.
Okay, that's fair. Joel, what do you think of liquidity?
Are you hearing me?
Definitely.
Okay, yeah, to me, liquidity is, in simple terms, let me say buyers and sellers in the market.
Okay. Mike, what do you think? So Mike said it is money we sell.
I could add, just maybe in a layman's language, the money that moves the financial market.
Okay.
Without it, the financial market will not move
All
or
right.
will not be active.
Okay, that's good. We sell.
Layman's language as well. I think liquidity in trading is the I don't know the sell stops, stop loss sell stops that people place.
Okay. Now, what is fun is that that's good also. What is fun is that everybody takes, I think, is it Blessed, you can mute also. I don't know if you wanted to contribute. Okay. So what is funny is that majority of us have been taught liquidity in a different way. We have been told that liquidity is when you see the equal highs, equal lows. Others were told that liquidity is by seeing the previous day's high, previous day's low, or previous day's monthly highs. Some people depict liquidity in form of buy stops and sell stops, or what you call the limit orders. And in actual sense, it's not like the way you're thinking. Because right now you're in the reverse mastery. Something you're going to notice that even before I execute into an asset that I'm going to trade, I put liquidity into consideration in a different way, not to the layman's way, or not to what normal traders do. You get. But liquidity, we can determine it in form of nature of the asset, volatility of the asset, volume of that asset, and clarity of that pair of that asset altogether. So what is liquidity in deeper way? Is the dependence between two pairs, between sellers and buyers, or this is the coexistence or this is the interdependency of buyers and sellers in a given time. You know, if we don't have buyers, definitely we should not have sellers. Are we together? That's what you should keep in your mind. So these guys should coexist. And before you go deeper into the forex market, you have to understand the business that you're in. Because if you can't understand the business that you're in, for you just matter of opening up the chart and execute the trade randomly to any key level, you'll be smoked out at any time of the day. Are you together? And now we want to even remove that rumor whereby people believe that once I have an area and maybe I happen to buy, I would be manipulated altogether. I want you to keep that off in your mind. You can't be manipulated altogether. The whereby people believe that the big guys, when they are trading, they are also manipulating us. It's not true. These guys are also following the order flow of what the market is doing. But for us to survive in the long term, we need to execute in the points where we expect them to reverse from. And that's one of the most challenging part to majority of the traders worldwide. It's very easy for you to open up to see a key level and you have all the anticipation that, okay, price will go to my way. And unfortunately, this happens. It goes further. And next time, once you open up the chart, you start having the fear of executing into a trade. As we said, liquidity involves understanding the nature of the asset, volatility of the asset, volume of the asset, and clarity of that pair of that asset. I hope we are together. But now you have to keep in mind that liquidity is determined in the form of ways of volume and volatility. And remember, our goal is to trade like the way the so-called big banks trade. They don't manipulate us. They also follow where they have to buy from. So your role is to find the right points where they're going to likely to buy from with high accuracy and sell from a key level with high accuracy. Are we together? So in simple terms, liquidity is the dependency between two pillars, who are the sellers and the buyers, or this is the coexistence of buyers and the sellers at the same period or at the same time. So that room of you've been thinking whether it involves having the limit orders, it's not true. All that's already invented. And I think you've heard of that term also, that liquidity drives the market. True. You have been through that situation whereby you're seeing structure, time, and liquidity. And liquidity correlates more with time than structure. Structure also correlates a lot with time. So you have to balance all these three from what you're going to be discussing. Now, when it comes to liquidity, we said we measure it in the form of volume and volatility. Now, under volatility, we know volatility is like measuring the speed, or it's the movement of price of a given asset altogether, how fast it can move. Volatility, it's volatility. Now, we can divide volatility into three categories. We have what we call the high volatility pairs, medium volatility pairs, and least volatility pairs. And now, what controls these volatility pairs, these guys, is what we call the contract size. Now, this is where traders get lost from the majority of the time. The outcomes, it is very easy for someone to deposit $1,000 on their account and use lot size 3, like 3 of them, and the account goes in their way. And yet, once you deposit $1,000, and even though you try to use lot size of two of them, it's easy just for a small drawdown to take your account to $100. It all goes back to what we call the contract size. I'm still under liquidity. Because for you to understand this business, you need to be like a proper businessman. If you've been having the mentality of you just trading anyhow, opening up the chart, you open up any foolish broker, you open up any foolish prop farm, whatever stupid asset, whatever stupid broker you're using or prop farm you're using, it will cost you in the long run. However much you get a good skill. But we do not understand how deep this business goes, you'll be manipulated. That's why you hear some traders will say, I have different charts from what I'm seeing. Price is over weakening me. I don't know why it is weakening me. You get. Now it all goes back to the contract size. After contract size, we shall look at the leverage, the science behind the leverage. Now, most people even have this philosophy under the leverage that for me to flip, I need to require to have at least unlimited leverage of 1 to 3,000. But in actual sense, there is a catch behind this guy, 1 to 3,000, and there is a catch between 1 to 100. And how do I join the side of the broker's liquidity provider? Rules. So let's go hand in hand. So let's begin with the high volatility. Remember, we said liquidity is measured in form of volume and volatility. Now you understand that liquidity involves buyers and sellers, right? And they coexist together. If I say by coexist, they have to stay hand in hand. They have to be depending on each other. If we lack one of them, there is no trade. As a businessman, you have to understand your business through in and out. Before even you try to deposit on your broker to trade, this is the first topic I'm teaching you about. Before you go into the deeper techniques, how to fucking survive. Because it can be easy for you to deposit $50 and you're able to trade and place it maybe lot size 0.05, but it's much easier for you to go in a drawdown of at least $30. And then this guy used lot size 50, sorry, account of $50, but he's using a lot size of 0.09. And once it goes in a drawdown, it's like only in 10. Some of you have not yet seen that. It's the thing that used to keep me in the dark, not knowing what I'm doing. And it all goes back to this guy. All of you have mastered structure. You've mastered time. Now we are into liquidity. Now liquidity and time will give us the final solution for the structure. So we have high volatility pairs, medium volatility pairs, and what we call the low volatility pairs. Are you together? Now, all these guys are being determined with what we call the contract size, which you call the volume. And what do I mean by the contract size? Now, if a broker gives you an asset with a contract size of 10, some brokers will give you a contract size of 10 to maybe a high volatility pair, and some brokers will give you a contract size of 100. Now, for guys who have been trading for quite some time, you're going to notice this, is that if you open up maybe like NASDAQ, hope we are together, and if this broker gave me a contract size of 10, this is going to be your homework. Be attentive here. If go over me a contract size of 10, if I happen to use 0.01 here, it's like trading a low volatility pair. For example, well, let's first look at the high volatility pairs. For example, like commodities, high volatility pairs. What are commodities? Gold, silver, BTC, and so all the crypto coins are together. Commodities, if you remember the commodities, gold, silver, gold against the Japanese yen, silver against the Japanese yen, NASDAQ. Now, be attentive here. Now, the medium volatility pair, those are what we call the majors, the major pairs. Now, these major pairs like USD, GU, USD CAD, GBP, JPY altogether. Then the low volatility pair like Audi Chef, those crosses, the miners altogether. Now, if a broker offers me a contract size of 10 and I'm trading NASDAQ with 0.01, it's like trading Audi CHF because these pairs move slow. You know the characteristics. You have to understand the nature of the asset you're trading altogether. And yet, if a broker gives me a contract size of 100 and I use 0.01 on NASDAQ, it's like using lot size 1 on a high volatility pair. That's why you find that that asset is moving so fast. It's the same that even there are brokers you guys you're trading, or the accounts that you're trading, whereby the contract size is 100, but yet you're trading gold, you're using 0.01, but the way the asset is moving, it's like you're trading with 0.10 lot size. Like the contract size of 100, it gives more power to your asset 100 times. That's why it's recommended for you to survive in the long term on small accounts or to survive on your accounts for your broker. Make sure you are on the contract size of 10. I will show you how to get the right contract size for the broker. However much you have any small account on Earth planet, you can flip it, you can take it further. And once you find yourself, you're being placed on a contract size of 100, you're doomed. However much you have a skill, however much you have the best funded account ever, they can still play you because they're not moving in the line of the liquidity provider. This is where I used to laugh at students whereby they started trading live when they are still learning the concepts. It was more dangerous. If they could have time to first understand more about their business, they could be the right businessmen. A good businessman understands his business. He understands the nature of the product. They understand how the product behaves. Some people take liquidity as something very small. They take it in the form of limits and orders, but it is a wide range of leverage, wide range of contract sizes, which is under volume and volatility. That's why it's very easy for a trader to wake up in the morning and say, oh, I want to trade gold because they're hyping the gold. Because gold is a fancy name. It is being hyped. It is seen as a luxury. But in the long run, they are still losing out on the same asset, losing more money because they don't understand and they don't understand the system, how it works, the nature of the asset. No matter what you do, if you can't understand the small basics of a business, you're gone. You just waking up in the morning and trading USD without understanding its nature. That's why the way you trade gold is quite different from the way you trade USD. It's quite different from the way you trade Audi card or Audi chef. It's quite different the way you trade GBP, JPY. The pressure is different. Volatility is different. The movement is different. The pressure you feel in gold is quite different from the one you're feeling in Audi card. Just because of this one guy. And 99% of traders were being told that liquidity is all about stops. It's all about buyers and sellers. It is far beyond. So you need to first know the nature of the asset you're going to trade. Is it a high volatility pair? Is it a medium volatility pair? Or is it a low volatility pair? Such that once you're playing with these guys, you're likely to lose because you don't understand the power of the contract size. And if I put all of you guys as you 7 of you in this Zoom session, and I put you on gunpoint, all of you will be dead. How to get a contract size for your broker. And what is funny enough, even baby tips is not even put there. It's the leading cause of why traders are losing out of money, yet they are profitable. And that's why once they open up their chart and they see their assets, they see the trading patterns, they get scared. Because last time it didn't work out. It just went. Or maybe it worked out, but they were stopped out. That's all under liquidity. Now, let's look at what we call that. Let's look at the leverage. Now, I want you to remember this. Keep in mind that when it comes to the leverage, now this is another catch that you have to keep in mind of. Majority of traders will keep our leverages 1 to unlimited, 1 to 2,000, because we are trying to make money at a faster rate, which is okay. But now this is the catch that majority of you don't know. Or from what I discovered from my mentors and from people I've been trading with, are all the mentors that taught me well about leverage. The truth about leverage is that people believe that if, okay, even I shouldn't even go there. Let me first do this. Now, when it comes to the leverage, you have to keep in mind that if you're using a high leverage of 1 to 2,000, 1 to 3,000, the broker will remove you from the liquidity providers approach. What do I mean by the approach? Like liquidity providers of trading, like trading the way the big banks trade, and they're going to be placing on what called the B area. This is the honest truth. Now, majority of people believe that flipping, you have to begin it from 1 to 2,000, 1 to 3,000. But in actual sense, you can even flip on 1 to 500, which is what we call the medium risk leverage. It's the medium one, which the broker can highly not change you from their liquidity provider's approach to maybe the B side to the losing side. It all goes back to what we call the contract size. I'll show you how to calculate the contract size, but it's going to be your homework. How do I get the contract size for the broker? You make sure you send me that homework. Do your research, but send me the homework before I teach you my method on how to get the right contract size from the broker. Remember, we have said there are two things that disturb traders: volume and volatility under liquidity. However much you see you're perfect in a trend, if you misfire one of those in liquidity, volume and volatility, understanding it deeper from what I'm teaching you today, you're gone. You'll have those so-called fake outs, and I think I remember Jog, I used to have that issue. Price waking him out. And even what is fun, even these things applied in the prop firms, if you didn't know. It's applied in the prop firms. They're also aware of how you're trading. Now, since you're setting yourself to that, now for the prop firms, they only follow the contract size. They don't follow the leverage because their leverage is fixed. Now, if you want to fucking survive in the long run with a broker, keep your leverage below 1 to 500. That's the fact. Now you'll be asking yourself, hey, how come that Josiah you're able to flip $60 to $20,000? What is shocking, my leverage doesn't exceed here. Because the broker is able to know who you are, the way you trade. There's something I'll release more in the next lesson about the leverage. And I'll try to show what I'm trying to mean by the broker knowing who you are. There are almost 99 traders there. Okay, let's look at the 80, like 35% of traders. They know what to do. They have the good strategies, or 60 to 50%. But it's very hard for them to remove an account from 50, especially with account to $10,000. It is very hard for the majority. Very hard. And yet on a demo, it is easy. 50 to 10,000 on unlimited leverage. If you know how to capture the contract size, it will help you to get the right lot, to get the right leverage and the right lot size you should be using on that broker. That's how powerful contract size are. Because if a person gets a broker, doesn't even give a fuck. All he minds about, does it give me unlimited leverage? Does it give me spreads? That's fucking nonsense. It doesn't work like that. That's what 99%. And a professional trader or a hedge fund trader will have to know the contract size of the broker, such that he can know the right lot size to know the asset he's trying to deal with. Because if the broker tells you that on commodities, we give a contract size of 100. Now, if you're a fool and this lot size 1, your account is going to go. Because here they're giving this asset times 100 power. They're giving it total strength to make you lose. But if it gives you commodities, those high volatility commodities, crypto, indices, those are all volatility pairs, very high volatile pairs. If they're in 10, well and good. It is easy to survive. Even though you have a win rate of 40%, you will see it, what I'm trying to mean. So think of how much you've been losing on the account without knowing this knowledge. A lot. And if you happen, if you happen not to find also this knowledge more, you would still lose more. That's why when I met Michael on a one-on-one, I told him it's not structure that controls market. Also not structure that tells you when to enter. It's liquidity that tells you when to enter. But when people hear liquidity, they just take it as buy stops, sell stops. My guy, it is another world of its own. There's a reason why these concepts, we call them the liquidation concepts. Haven't you seen areas whereby they have buffers and price goes through them? Haven't you seen them again whereby again price respects them? Haven't you seen whereby an M5 small zone, it is able to produce a monthly candle? Haven't you seen the daily zones being taken out? But you find just like a 15-minute small zone, it's able to produce very strong momentum. And so when you try to grab it, you're taken out. Even the broker will start even creating for you different candles, different structures, because they see how you're trading. Brokers only have the power to manipulate you in the candles. The moment you change your leverage from 1 to 500 and above, I'm being open to you guys, and above, definitely, the first loss that you make from the flipping account, they will definitely move you from the liquidity provider's approach, they take you to the B side, the losing streak, whereby they will start, creating for you fake trends. But big banks don't create, they don't manipulate you. It's the broker who will create for you fake trends. Don't forget that. Our role is to remain this side from the broker by understanding the contract size. We can't go and say, broker, why you give me a contract size of 100? No, they're trying to give you an opportunity, but you're getting blind here. That's the first thing I tend to ask brokers when they come to do affiliate marketing with me. What's the contract size for the commodities? What's the contract size for the major pairs? So that I can know, can my people who are going to follow me up in my social media, are they going to make sense? Are they going to make money? In actual sense, they're going to lose more money. That's why it's easy to open up. It's easy to open your friend's MT5 and you happen to see this guy has a long week. This guy doesn't have a long week. And all of you using the same account standard because one of you is being misplaced. Now, from what you're going to learn today, if you've been trading on any account and you have more deposits than withdrawals, you have to stop now. You have to stop now. Because the next session, when I'm teaching about the leverage, before we go into the deeper understanding of these concepts, you're going to wake up. because it will be still useless for me to just teach you and you still make several losses. This was the first topic that I was taught, by the way, if you didn't know. It was the first topic that I was taught, liquidity. After rotating a whole bunch of concepts, seeing all the shift inside formation, blah, 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 blah. No matter what you do, price will go through. Right now, it may not make sense to you, but you're going to understand it in a very short time.
Excuse me, Jose.
Yes.
Before we go for, I want to just understand something. The contract size, if I got it right, the smaller the better. You said 10 is better than 100.
Definitely.
And then we also said, is it per instrument or just per broker? Is it something that is per broker or per each instrument we trade has a different contract size?
It's each broker. Each broker provides a contract size. Even prop firms will provide contract sizes. It is something that brokers are not willing to advertise on their pages. I'll show you how to get contract sizes, but I want you to go and do the homework, how to calculate the contract size from a broker.
Okay.
It's just per broker. If per broker, the broker will tell you, okay, now for commodities, contract size is 10. Okay, well and good. If it's 100, you have to be careful. Now that's the catch. I've seen brokers like XM. I've seen brokers like Hot Forex. I've seen a broker like this one who's in Uganda now. I'm forgetting. Is it HFM? Some of that sort. XNES also offers almost 100 in the standard accounts. People are not aware. Why is it even easy for you to see that, yes, the broker is producing a bullish candle going? You happen to enter price retraces more, then it goes in your way. But you open up another broker, just did this retracement. Those are small things that people are not minding about. And yet you had here $50, you put in 0.099 of them. But this guy survived. This one was taken out because the leverage. They already put you on the other side. If you go exceed 1 to 500, I'll show it to you in the next session what I'm trying to mean before you do those tests to observe. Even prop firms do this. They do. It all goes back to liquidity. Your role is to know the high volatility pair, medium volatility pairs, and low volatility pairs. It's your role to know. All these guys have different nature of approach. You shall see them by time. You'll see them. Gold behaves differently from Audi Chef, Audi Card. It behaves different from GBPSD. If you've been trading gold for the sake of, because it's being hyped, it moves so fast. If you don't understand the system of liquidity, it will be a gone case. The nature of the asset speaks louder. Now, let me give an example. If you go to your brokers today, go and observe the chart that I posted there. It was from XNES. If you go to a standard account, the week was here in the morning for people who have manipulated areas. So those accounts who don't understand them well, then you find that mine is here. What is the catch? Why is it easy for me to use lot size 1 on an account of $100. For it is hard. In a small teaser, you're gone. A small teaser. Because they know you, the brokers, not the big, not institutional. The institutional banks are just like a small fish. Them. Their role, they're also following the order flow, what the market is speaking, because the market is also determined by economic factors and political factors and anything. Because they're also following. The big banks don't manipulate us. Our role is to find how they are going to enter, from which I'm going to show you with precision. Because my role is to push you from 65 to 70% win rate to 95. I decided to teach this because it will be easy for me just to go and begin with the topics of direction, blah, 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 blah. But this is the final warning. If any of this content leaks, it will be the end. I'll just refund anyone their money. That's the fact. If it leaks, I'll have nothing to do. I'll just refund you guys back your money. But I'm happy that the previous lessons weren't leaked in, weren't leaked. So you have to understand liquidity, unless someone has a question before we go further. Joel?
I have a question. Okay, we said that if my losses on an account is more than the withdrawal, that's changing the leverage back, say to 1 to 100. Like I have this account I opened when it was 1 to 100. And then because of the appetite of flipping, I changed to 1 to 2,000.
And you lost
it's
it.
Changing it. And I've been losing in it.
That one, you have to close it. You have to close
okay.
The highest leverage you should be stopping on is 1 to 500. I will show it to you in the next lesson for leverage. Understand leverage more. When you exceed 500, the broker automatically, they have already triggered their systems to put you on, not on the liquidity provider's area. Altogether.
Excuse me.
Is there a question?
You can ask.
Yeah, so does that apply to the accounts, or like any account you open, they'll just put you on the other bondi?
Yeah.
The other side.
Yeah. Any account, whether it is row spread, whether it is what. I'm going to show you my when we learn how to do the contract size, when you guys finish and maybe I come and correct you, I'm going to show you, I'm going to give you my investor password. I want you to observe something. On all the accounts that I tend to flip on, I don't exceed 1 to 500, which is funny. My maximum is 1 to 500. You may not believe, but you'll see it for yourself after doing the math.
I think your network is not clear, Josiah.
Okay, can you get me now? Yeah, what I was saying, for the accounts.
I have a question.
Okay, you can ask. Okay.
Before we go further, so contract sizes, do they also like work with forex pairs, or they just work with, I don't know, the Nasdaqs, the US 30, US 100? Because me, I thought that's where like they work.
Okay.
In.
Let me repeat it again. Contract sizes they focus on the volatility. It means volatility of an asset. They don't only stop in forex pairs. They even go beyond to synthetics altogether, to indices and crypto. That's why I decided to do what? To categorize them into three altogether. They all act differently. If you're going to trade a high volatility pair, then we have medium volatility pairs, then low volatility pairs. High volatility pairs, these are the pairs that move so fast, but they are caused by what we call the contract size. Like if these high volatility pairs for that broker, maybe like, let me give an example of high volatility pairs like NASDAQ, gold. Gold is a commodity. Gold, silver, all those are commodities, and crypto, indices, all those are high volatility pairs. Now, this is the catch. This is what I was trying to, let me repeat it again for you. For these guys, if the broker gives me a contract size of 100 and I'm trading gold or maybe any commodity or any indices and it's 100, if I use, even though I use 0.01, I've ever seen when you try to trade NASDAQ on some brokers that 0.01, even though it moves by 10 pips, it's like putting lot size 1 in NASDAQ. And yet for other brokers, once you put in 0.01 on NASDAQ or maybe on some indices, if you move by 10 pips, it's just move like $10. But for other guy, you move like $100. Who has ever seen it? Or maybe when you're trading gold, you happen to use 0.01. But you find out that by 10 pips, this guy is already like 50,000 Ugandan shillings. And for others, it's just like 25,000 Ugandan shillings. What's the catch? It all goes back to the contract size. Maybe the contract size is low here, 10. On these high volatility pairs like gold, NASDAQ, this is when you find that it's just making $10, 30, and it's easy. Such that even when you make a loss, you're not traumatized, like the way earlier before. So you keep putting 100K Ghana cents on your funded on your account. You want to grow the 100K to take it to 2 million Ugandan shillings, but it is a challenge to exceed 200K. Yeah, just because you're playing with a high contract size for that broker and there's no way he's keeping quiet. They're only advertising to you high leverage, small spreads. But it's very hard for you to take 100K to exceed 200K. Or maybe it's hard for you to take 200K to exceed 500K. It's like a threshold. You feel like you're stagnant. You may even think you're bewitched, but you're not altogether. Yeah, so that's how dark our business is. That's how dark our business is. That's what for
One
you.
more thing.
Okay.
So basically,
Mm.
contract sizes and lot sizes move hand in hand because I'm still confused.
That's why I'm going to give you that homework to first understand. You're going to research how to calculate the contract size for the broker. Then you give me your answers before I correct you.
Okay, so before trading anything, like before trading any pair, before trading anything, you're supposed to first, because we used to trade before. I don't know. Let me talk like me. I used to trade before. I never used to mind about contract sizes. It's just used to be about calculating the lot size.
Mm.
That's it.
Mm.
So what you mean, like before trading, we have to first check the contract sizes.
Definitely. Before even you deposit on a broker, first understand what are the contract sizes. Then you have to understand the contract sizes before you even try to calculate the lot size. Once you understand the contract size they're offering, it will be easy for you. I'm going to show you that method altogether on how to correlate it with the right lot size, such that even though you're in a drawdown, it doesn't affect you. It feels like it's nothing. I hope you understand it.
Yeah.
Even though you happen to make a loss, it takes a small fraction from your account, very small, because our role here is to end what we call blowing. Because where I'm taking you is to survive also on small accounts. Don't forget that. Because it's going to reach a time whereby you guys, You may not afford a funded account. Think of it. But you want $50,000 to do something. But again, you want to go through the hustle and the bustle of raising $50,000. I know this may feel like a candy land or something, but it is possible. It is possible.
Yeah.
Mm.
So what's the difference between the standard account and micro account?
We shall all understand it after mastering the contract size and the leverage. Yeah? Some people compare them. Yeah, some people compare them in form of. Some people will say, "Ah, standard account has big spreads." True. Some people would say it has a smaller spread, a zero spread, a row spread. My guy, there's science behind these guys. They're not for decoration, but that's a good question you ask, my guy. That's what we shall look at in the next session. It is very, very powerful. Now, if you open up your Xness, don't be surprised when Xness has not closed below here. Maybe when this guy Bitcoin is below here, when maybe your broker is here. I need to marking a V2V. Are we together? It all goes back to the volume and volatility, which is liquidity. That's why even some topic of liquidity, we shall even be focusing on the momentum, more of that momentum. Momentum. Some people call it the approach, the method, how it comes in, but you're going to overcome all those challenges. You will. Don't forget that structure will give you direction and liquidity will tell you when. But that was a good question. We shall look at it well, deeply, very well.
Another question, but it's kind of away from this topic. Before we go further, there's something that's disturbing me. How do we? Okay, how do I? Let me say, add up the XEC with this mastery, because okay, sometimes it confuses when you're using mastery. Then you kind of see an XEC setup. Then if you try to join them together, you get confused, or you can even get wrong trades. So I don't know how easy can it be like for me to join them together and use them both.
Okay. Now, have you heard of too many books spoil the soap?
Yeah.
Remember when I began this lesson, I told you one thing. Whatever you're learning, what you learned in the past, you're going to leave it behind. But it's going to help you. And you understand the mechanics. Because you learn a shift in inside formation of how it happens. Yeah, why are we even taking a trade here? This is what we are looking at. So basically, just have that general knowledge behind in your mind. But when it comes to liquidity, it is quite different from the way you see the market. Hope we are together. Like, I don't want you to put in so much hope. Like, don't take reverse separate from XEC. They are the same. But here we are removing the dust that is here, which is understanding liquidity. XEC only taught you structure and time. Are we together?
Yeah.
Here we are focusing on liquidity. That combines it with time, not even structure. Structure this side is useless. I can decide to sell here if liquidity permits me. If it doesn't permit me, I'm wasting time. I hope we are together.
Yeah, so the main gist is liquidity. Then others come after.
Thank you. If you've heard of that common saying, liquidity drives the market, it is true. It does. That's why some people can compare liquidity, they call it external range liquidity, other people call it internal range liquidity. All that is bullshit. Yeah, it is liquidity. It drives the market. And I think I had a conversation with Wisal one time. She discussed me how she had learned about liquidity. You get. But now you're going to go down in the rabbit hole. Now, let me give you an example. By the time you guys joined, I think let me make it easy for you. For the guys, by the time you join Forex trading, you focus, if the first time you learned about Forex trading, you first learned about those theories, blah, 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 blah. Then later you went into the structure. You mastered structure, which is support and resistance, but you're not understanding the science of what is making price over test here. And if you remember well, the next issue, when I used to say that thing, sufficient and insufficient liquidity. How comes it is easy for me to know that here is a flip level, here there's a cross model, but I know it's going to hold here. And it next is I'm telling you, I wait for a confirmation. And it most of the time has mean secrecy, I'm taking that trade. What am I relying on? Is it a myth? Am I relying on a belief? No. I hope I'm making sense.
Out
Yeah.
of it, been wondering why you get a sniper, but when I try to get, they take me out. Now I understand my type of account was the problem.
And also understanding liquidity. There's some things that you need to understand in liquidity also. Are we together? So that's why when we began, we focused on structure, support, and resistance mainly. Then after some time, you going to realize that time frames are disturbing me. Combining time with structure was also a hassle for majority of you. Now you've mastered time. Understanding time frame coordination very well, right? You know that weekly connects with 4 hour. The reason why we move from weekly to 4 hour, because 4 hour structure, the weekly candle is more or less like having 5 daily candles, which will not show you the intestines of what weekly is communicating. But 4 hour structure will show that the intestines of what weekly is communicating. Are we together? Now, when we come with the liquidity, it's going to tell me levels that are going to produce momentum. So basically, we are looking at momentum generation, because momentum, that's where we're going to make money from, not in structure. How many times have you made enough money in structure? Less. How many times have you made money in time frame? Less. I don't know if you're making sense here now. Now, this is what you're lacking. Liquidity. It goes through the broker, it works through the structure, it works through the time. All of you here, you're good. Here, you're good. You can mark support and resistance levels. You can mark V2Vs. You can use any indicator, moving average, stochastic. You know, you understand the time frames. Now, the biggest of now, what is for 99%, sorry, 90%, sorry, I think here, let's make it 70% of traders here. No structure worldwide. 20%, 20% understand time frame. Who are those are especially guys of SNR. How comes they have more win rate than the guys who do smart money who are here? Now, here in liquidity, it's almost like 10%. And guys who are in 10% are the hedge funds. Because we need to trade like them, hedge funds, investment banks, central banks. Are we together? Here you're good. All of you here, you're good. You can mark for me a V2V. Oh, this is a V2V. Oh, this is a V2V. So, are we together? You can see the V2Vs. You can see this V2V and you get scared, you can take a sell or take a buy.
That is very true.
Are we together? That's why it is very easy for you if you observe structure, time, and liquidity. These are three things that most traders miss out. If you observe very well, someone has been trading for quite some time, smart money traders, they follow a lot of structure and liquidity. They forget time. That's why I find a person that does smart money and ICT, they are confused. I'm moving from 4 hours, it's going 15 minutes. He has even low probability of knowing whether this 15 is going to work out. Then when you go to SNR, advanced SNR, these guys follow structure and time. They don't understand liquidity. Then when you go to indicator traders like BTMN, BBMA, they only use structure and liquidity. But their liquidity, they understand it at least they try their liquidity 20%. Then ICT is 5%. All of you guys.
There's no way we're going to get.
Are you seeing that? Support and resistance only structure, supply and demand. They only understand structure and time. They don't understand liquidity. The liquidity, they base it on fair value gap. That's why they stop. All together. Sorry, what they call the imbalance in supply and demand. Smart money, they call it fair value gap, and they only stop it on what you call the internal and external range. That's why they stop. But what you're going to discover, it is more. Only 7 layers that you need to add up. So this is what you've been. I hope we are together now with Joel. Here you're good. It doesn't mean that you have to come and harness them here together. This is the final guy who will tell you now, yes, you can see zone, which I know now you can solve the zones. But when price is approaching, this is where fear comes in. And I know, I've been there. You take here sale, then price gives a few more.
Too much fear.
So much fear, thank you. Then this happens, it goes, they say, okay, let me continue the buys. Now you're saying the buy, there's a wicked sale here. Then you start getting scared. As you feel of taking the sales on that week, it continues hard. Then you start doing this thing for cramming. You're cramming now momentum. I saw the structure last time. I think I shouldn't do the same mistake. Why? Liquidity. What you call liquidation. If you understand the liquidation concept which you are going to learn, it is much easier. Because our role is to remove you from what you call the pattern trading. Now we want to eliminate that fear. That's why here, structure, all of you here, you're good, I know. You can even go and teach some amateurs, and they feel like they're in heaven. Structure, time, liquidity. Now, when we go for the next lesson for leverage, I think your mind, you guys, will explode. Trust me. I've just given a small sign for leverage, but it's something powerful with leverage. I'm not showing how to capitalize with leverage. However much an account is on just $2, you can capitalize. However much account is on 50,000 Ghana shillings, you can capitalize.
Of course, my next question, I've seen people raise $5 to 100,000 US dollars.
People do it. Haven't you? There's some
one trade.
There's some guy whom I know on TikTok. He uses trend line. He uses Falcon strategies on a trend line. You get, but he's using synthetics. But I know his trick. His trick was under contract size. That's why he was able to take. Because I noticed he was using derive. Because derive in some synthetic pairs, the contract size is reasonable. It is very easy to take an account from $0.30 to 5,000. Think of it. On some synthetics, I'll show you. But remember, using trend line and is using what we call subjective trend lines. So if I mean something subjective, it means that it's just relying on patterns, no confirmation. but he's able to take account 5,000 because he understood the power of the contract size. And this is what majority of expert traders are hiding from you. Why are always some traders trading on a raw spread? Why are some traders always trading on a zero spread? Some people they regard them in form of spreads. It is something deep and sinister. It all goes back to the contract size, volume, and volatility. They will save you a lot.
And I've not seen books on liquidity.
They are not there.
Not even YouTube videos. All YouTube videos are on structure.
Definitely, because the system was designed for someone to lose. That's the. It was designed for you to lose no matter what. No matter what you do. You get. Now I've just got a message from someone. Man, is I'm smoked fast trade Zalo says just bought his funded account today. So you have the fear even to take the sales. You have the fear to take the buys. I know I've been there. I know what it means. Just because, as I told you, I'm going to remove the dust. Liquidity is very important to understand how zones are formed, how to get early zone entries, how to have high probability when market is going up, but it's not going to retrace. We know the right exact points for retracing. You think I'm just guessing work of putting in an entry? No, I'm not guessing work. I'm putting in the effort. I put in the effort to understand how the system works. As a businessman, remember, you have to understand how your business works. Because being in a business whereby you don't know how it works, you're gone. Now, leverage, we shall understand it together with what we call the brokers STPs. Yeah, this one's going to show you how you need to capitalize on your leverage more. After mastering how contract sizes, you do that homework today for contract sizes. I'm going to mark and I'll send each person on how to do contract size, how to get a proper contract size. And once you start trading, even though you're going to start trading from what I've taught you, small of it, you're going to notice a difference. What I mean, you're going to even start dropping brokers that you've been using. You're going to stop using you start using the standard accounts at a given period after understanding the leverage of how it works. If you shouldn't want to be going to the side of the broker, of the B side, don't exceed 1.5 and do whatever broker that you know on Earth planet.
Jose, now, how about these guys who have leverage of 1 to 30? There are some prop firms, I've seen like FTMO, the swing accounts. They have leverage of 1 to 30. And I remember sometime you told us that we shouldn't get those kind of accounts with that leverage 1 to 30. So I don't know if that's part of the contract thing.
Now, for contract only focuses mainly on the brokers and also some bit of prop firms. Prop firms which are willing to show you the contract size. But under the leverage with STPs, we shall understand more of that topic. Why I'm explaining about the power of the leverage. Why are brokers putting their leverage sometimes at 150, some prop firms, 150, 130. What is the catch? 1 to 10. I think you've seen it.
Yeah.
It's not for decoration. And what is funny, I think I may be open to what is funny. You realize that all strategies work after learning all this by just small minor things that keep people in the dark. Keep people in the dark. Keep people in the dark. Very small minor things. Someone can see this video, they have all the fear. Can I take a sale? Can I take a buy? I feel my strategy is lacking something. I told you, I think I've ever told some students, I can say shift with inside formation. I don't know what to do. Can I take here? Sell or is it going to come back here? Is it going to come back here? Is it going to come back here? Is it going to come here? Can't I even just put a trade and sleep? I know all those questions. I know. And they will be answered. How together? You get, I'm seeing a shift with an inside formation. Quasimodo wasn't tapped it, but it went here. I was thinking that there's a Quasimodo, there's a V2V here, there's this one. Price respects it and it goes. How did it produce all this momentum? And later you come back and say, oh, I missed this entry. You see some shifts with inside formation, they don't have confirmations like buffers. Altogether, it's just because you're lacking that thin liquidity. You'll understand it more. But keep in mind, so that's the mentorship structure. If you don't master these places, you go now. Structure, time frame, liquidity. Our role is to put you here now. When you do this, I think I talked to who I told him what makes someone develop high confidence of trades with any lot size is what we call the skill or capital. Those are two things that can save you. But majority of us lack capital. But this guy overpowers every time the skill. If you don't balance these three, but these guys, you're already experts here. Here are the experts. You've seen, you know how the shapes look like. You know this, you know that. But now adding in the soup. So that's the lesson for today. On Thursday, Mike will send us the link. Sorry, on Friday. On Friday at 2 p.m., he will send me the link, or he will send all of you guys the link. Then we go deeper into something leverage. Then we go with our first topic for liquidation concepts.
Excuse me. So after like studying the liquidation concept, it's when we're going back to finish the other time frames, like weekly, the 4 hour.
Yeah, because I thought of something. I saw something, a mistake. Any question? So Mike will send us a link, but for those ones who want a personal one-on-one, you can still schedule. Then we meet up live one-on-one. Is it okay? For those who can be free any time of this week before we have our next lesson. Either you want to boost your mindset, either you want to boost your overall approach of the market, or you want to first remove all the dust that you had previously in your mind.
Yeah, I have many questions.
Yeah, you can approach in any one-on-one physical. Because this week I'll be free, but I have to cook for you very well by Friday. I have more storming organized work for you. Then Friday, all of you will wake up from the sleep. You'll stop doing whatever you're doing. Now, today you've learned the brokers that you're using are the effects that are causing to that. So you've been putting money on your broker now, just save it for the meantime. If you've been
I'm
buying,
tired of giving them money.
Don't need more money. You've been good.
I'm giving them more money. Going to close all the account. So the homework is okay between now and before Friday.
Yeah.
Is the homework just to get it clear to calculate each broker's
How to calculate contract size.
how to calculate a broker's contract size. Okay.
Yeah.
Contract size.
You will notice something unique.
So the who is a monopoly, his contract size is on each volatility.
Hello?
was just wondering for the rave, it's a monopoly on volatility.
Yeah, but not actually true.
Yeah, okay.
It's not actually true.
At least let's do our investigation and see.
And if you can find a clue about contract size and how they work depending with the asset. If you can. Are you together? Find a clue about contract size and how they work depending with the asset. Just try to do some bit of research there. I'll show you what I'm trying to do. Then I'll correct you in the inbox there. All right. So if you open up for any one-on-one box, you schedule a date, meet up.